Hi, everyone, and welcome to Tips Tuesday. I'm Chris Rowlins, partner and senior consultant at Fiducient Advisors. Today, we're going to focus on alternative investments and liquidity and how investors should balance return and diversification benefits with short and long-term cash flow needs. Alternatives is an umbrella term for different types of investment strategies that can range from private equity, hedge funds, and private real estate. Alternatives are uncorrelated to traditional stocks and bonds and may serve to improve a portfolio's risk-adjusted return. As with any investment, alternatives should be evaluated in the context of an investor's risk tolerance, liquidity needs, and investment time horizon. Public and corporate pension plans that allocate to alternatives must do so recognizing the unique circumstances of their plan liabilities, investment return assumptions, cash flow needs, as well as time horizon. For public pension plans that rely on liquidating assets from the portfolio to meet monthly pension benefit payments, the liquidity restrictions imposed by alternative investments may result in a disproportionately higher allocation to alternatives within the portfolio versus prescribed target allocations. Therefore, investment policy statements should include language and guidance that consider allocation to alternatives that may drift from stated targets due to mark-to-market position in other areas of the portfolio, and the inability to readily rebalance an alternative allocation due to illiquidity features. Similarly, for corporate pension plans that have incorporated a portfolio de-risking glide path, where the allocation to non-hedged assets is gradually reduced as a plan's funded status improves, or considering a lump sum window, pension risk transfer, or possibly plan termination, an assessment of the liquidity provisions for the alternatives bucket within the portfolio should be evaluated accordingly. So using open-end private real estate as an example, the quarterly redemption feature offers investors the opportunity to redeem assets. Investors seeking to sell off full or partial stakes in open-end real estate funds are placed in the fund's queue, where all client redemptions are aggregated. Should the fund have ample liquidity, it's likely that an investor would receive their full redemption. However, during periods of market dislocation or elevated levels of redemptions, there might not be sufficient liquidity in the real estate fund to accommodate all investor redemptions. Under this scenario, investors might only receive a small portion of the redemption request based on their pro rata share in the fund. And this restrictive liquidity scenario can remain that way for an extended period of time. Alternatives have the potential to provide diversification and higher returns than public markets. For investors with compressed timelines or other constraints, the relative appeal of alternatives should be balanced accordingly. That's it for today. Please visit fiducientadvisors.com for more of our research and insights or to learn more about our firm.